While Sherry's getting us ready, I just want to begin by thanking everybody. I appreciate you making time in the middle of the day and doing this work in your service to the city. So thank you for that. Sherry, can we get started?
Okay, I want to give you a thumbs up in 2 seconds. Oh my God, what happened? Can anybody hear me?
Yes.
Yes.
Hold on,
Can you hear us, Sherry?
yes, I don't have it on the screen for some reason.
Okay. So it says that it's live streaming, and I think we can all hear each other.
Hold on 1 second.
What are you trying to do, Sherry?
I don't have any, on my screen, I don't have people on my screen. So I
Okay.
can record.
Okay. I think that's fine, though. I mean, it's showing up on my screen.
Sean, excuse me.
It's live on YouTube.
Nothing happened. I just went live to YouTube, but I don't have a screen. I don't have anybody on the screen, and I can't even go to record. I don't have anything on my laptop. Yeah, but it's not letting me, that's not letting me in. What's that? Yeah, everybody's on. It's live streaming, but I don't have anybody on the screen. They can hear me, but I can't see anybody. And it says updates available, Zoom. It's asking me to join meeting. Everybody's on, but I already joined.
Hello?
Yeah, we can hear you, Eric. I think there's Sherry, the clerk is trying to troubleshoot some stuff.
Okay. All right.
So, Sherry, can you hear me? Sherry, can you hear me? I think we can manage. I think we can manage okay.
Mayor, I'm consistent with your opinion. I believe if it's being taped, it's being transparent, the members can see each other and
Yeah.
hear each other. I think we're good to go.
Yeah. Okay. Hi, Sherry.
Oh, I'm sorry.
No
We're ready
worries.
to go. Okay, sorry about that.
Okay. All right. It is 12:08. We'll call the meeting to order. Again, thank you everybody for joining us and for giving your time and service to the city in this capacity. We will begin by doing a roll call attendance vote.
Mayor Alorza,
Present.
Vice Chairman Lombardi.
Present.
Okay. Councilor Figliozzi. Absent. Ms. Silveria.
Present.
Mr. Costello.
Present.
Mr. Hirsch. Absent. Mr. Winkleman.
Present.
We have 5 present, 2 absent. We have a quorum.
Okay, great. We'll get started with matter number 1 on the agenda, the investment performance analysis, and we'll pass it to Eric, please.
Thanks, Mayor. If you turn to your position and performance analysis as of February 19th, the electronic number is page 4. The physical number is page 1 at the bottom of the page. You'll see that the rally, for the most part, that we've been talking about in recent months has continued. It's been quite volatile, for sure, but it has continued. You can see very strong returns month to date and year to date. Year to date, we're up 3.3% through February 19th. You can see that the pattern we've been talking about in recent months has continued. Value has, and small and mid cap have been generally outperforming large cap, and value has been making up a lot of ground against growth, for the most part. But definitely small and mid cap have been doing quite well, outperforming the larger cap shares, and that's been sort of a mostly continuous in recent weeks and months, for sure. The last few days have been very volatile. The last week of January was very volatile. The market sold off over 3%. But nonetheless, even with that volatility, you see that the portfolio is behaving very well. That's a very strong return for markets and the portfolio for only about 6 weeks or so. Portfolio is up to $371 million, as you can see. This has been based on a couple of things, and you'll see it expressed in the portfolio, but the caseload, the virus caseload has been plunging. It's down probably 75 to 80% off the peak. So our hospitalizations are also coming down, and daily deaths are also, for the most part, coming down quite substantially. Additionally, so that's great news, and the vaccination rollout has been accelerating. We were doing 1.6 million or so a day nationally until recently, when we had some very bad winter storms in Texas, in the Midwest, and in the Northeast. That slowed things down a little bit. But both vaccine availability and the rollout, the actual injections, has been picking up, and markets are seeing that. They also saw the very large stimulus program that was passed in December. That money is only just starting to get out and flow through the economy, and you're just starting to see that in the economic numbers, which have been accelerating after a 2 or a 3 month weak period. You're seeing that. And it is quite clear to markets that an extremely large stimulus is about to pass, additional stimulus. Looks like it'll be through the House. President Biden's $1.9 trillion stimulus plan looks like it will pass the House probably this week, maybe Friday or early next week. Then it'll move to the Senate, where it will be, might go down in size a little bit. It's going to be a little harder to get that full package through. Some things might not make it, but markets have been upping their estimate in recent weeks as to how large that stimulus will be. It will be at least $1.5 trillion, maybe more, which is huge, which is just no way around it. It's gigantic. And so you're also starting to see things we've been talking about in recent months is now starting to see more and more analysts, economists, etc., on Wall Street upping their estimate for GDP growth. And I'll say it this way: GDP in the U.S. will grow by at least 5% in 2021, probably 6, maybe even 7 or 8. It's going to be very, very strong. And you might see, for example, in the second quarter, 8-10% growth, real GDP growth, which is just astonishing strength for an economy that size. And much of it is due to the things we've spoken about, stimulus and much better news on the virus in many dimensions. And folks are just pent up, and there's a lot of pent up demand, and that's going to feed through to the economic numbers. So in the coming months, you're going to see very strong economic numbers. Earnings are going to soar this year. They're going to just absolutely soar, say at the S&P 500. They'll grow at least 15 or 20%, probably higher than that, maybe 25 or even better. So that's going to be that's starting to get priced in. One of the reasons markets in general have been going up. But what you also see, if you look at your, say, your bond exposure, you'll see that those are down, 60, like Loomis sales is down 60 basis points year to date. Your treasury exposure is down 1.3% year to date, for example. So interest rates have been rising, and very recently, in the past few weeks, they've been rapidly rising. And as we speak, they're up at around 135, 137, 138 on the 10-year today, whereas just a matter of weeks ago, it was around 1%. And of course, earlier in the pandemic, they were much lower. So we're still quite low historically, still very low historically, but they have been rising rapidly. Inflation will pick up later in the year, and that's what the bond market is seeing. It's seeing a strengthening economy, so that's very good. The real interest rate, so of course the interest rate is two components, the real rate and the inflation rate, the expected inflation rate, and those are both going up. That's good. That's reflationary. It's what the Federal Reserve wants to have happen, and that will at least happen somewhat here in the middle of the year. There will be what's called base effects, where there will be, very weak or low inflation numbers that'll start falling out of the year-over-year series. So you'll start to see inflation get back up towards the 2% target. In fact, the Fed wants it to go above 2% for quite some time. They want it to be moderately above that, and they will tolerate that. So markets see that as well. But that is the good news in the economy, and the good news with the virus is what's leading to the fixed income exposure being down a little bit. So we think that markets are going to be very volatile this year, like they have recently. Again, they fell over 3% the last week of January, recovered. They were down about 4 or 5 days in a row, several percent here just now. Very volatile as we speak, although they're up nicely today. And this is on interest rates right now. We expect that to continue. The takeaway is that while we think that it's going to be a strong market for equities this year, we also think that, as it has been for the last 6-9 months, after the initial shock of the pandemic, that there will be more sell-offs. We think that's going to happen again. You may recall in June of last year, the market fell about 8.5% in 4 days. And in September and October, it was down 6 or 7% twice, for a total of, at one point, about 10% sell-off. We wouldn't be surprised to see that happen again, because markets have been so strong recently. We see our hedge funds as well. Our Quellos is up. That's a very broad fund of funds. It's up 1.7% year to date. Well, Renaissance is up, down over 8% year to date. We'll talk more about that as we go through the report. There's a good bit in the report. There's a good bit more to do. But in general, the month has been quite strong. So have markets, and so have the portfolio's return. Again, driven by equity, whereas bonds are, for the first time in a long time, actually a drag on the portfolio. So I'll stop my update there, Mayor, if there's any areas of questions, etc.
Okay, I'll open it up to any questions or comments, but I will remind everybody that our next matter on the agenda is a consideration of rebalancing or reallocation, and a discussion relative to rebalancing the fund. And so there will be an opportunity to also go into detail on any of these investments in the next part of the agenda. But with that said, I'll open it up to any questions or comments that folks may have at this time. All right. If there are no questions or comments, then I'll entertain a motion to accept the investment performance analysis as just delivered. Is there a motion?
So moved.
So moved by Commissioner Winkleman. Is there a second?
Second.
Seconded by Commissioner Costello. Any discussion on the motion? All those in favor, please say aye.
Aye.
Are there any opposed? Okay, so the investment performance analysis is accepted. And we move on to matter number 2, a discussion or decision relative to pension portfolio asset allocation, review, and or decision relative to rebalancing of the fund. Go ahead, Eric.
Thanks, Mayor. So if you turn to page 15 in your electronic package, or page 12 physically at the bottom of it, but it's either electronic 15 or page 12, you'll see a hypothetical new recommendation, hypothetical portfolios with a new recommendation. Based on last month's meeting, we were asked to consider a rebalancing or reallocation based on general macro trends and the environment that we're in. Also, it was requested to consider smaller allocations to individual managers. That was the subject of last month's request. And so based on that, we have a potential rebalancing or new recommendation to consider, and that is laid out at the asset class level on page 15 electronically, or page 12 written, the pagination on the actual page. So you can see where our current target is. That's what we've had for about a year and a half. And what a potential new recommendation would look like should the board want to go in the direction of smaller allocations to individual managers. So there's a lot of moving parts here, and you'll see it as we go through the other pages. But with page 12, again, or 15 electronically, you'll see that we reduce the exposure to hedge funds by 8 percentage points, and those percentage points are added to equity. So the total equity target would go from 58 to 66 in those various weights. Fixed income would remain the same at 26%, and alternatives would fall to 8% from 16. And we show the long-term expected return on those two portfolios. And you'll see that they're both around 6.9%. This is a function of interest rates. So you might say, geez, why is it in the high sixes going forward? Well, interest rates have plunged in the last year and a half. Fed funds were, up around 2%. They're now 0. And the 10-year was well over 2%, and it's been hanging around 1%. In the last couple of weeks, it's up to 1.3 and change. But interest rates on the Treasury yield curve are sort of the raw material. And when you do your analysis, you make your predictions for the long run, that's what happens. So these are the long-term expected returns and standard deviation, et cetera, for the current target and the potential new recommendation, which again takes 8 percentage points from alternatives and moves it to equity going forward. And you can see what happens. We increase large cap value, we increase growth, large growth, we increase mid value and growth, small value and growth. We essentially keep international the same, the totals anyways. And we also increase the two-factor plays, momentum and quality, by 0.5% each, from 2.5 to 3. So that is the response to the request from last meeting at the asset class level. And in pages going forward, you can see, the efficient frontier, et cetera. But what goes hand in hand with that for consideration and discussion would be electronic page 20, which you could look at as well, which actually shows how we would get there should the board decide to accept and go in that direction based on last month's discussion. So if you turn to page 20 electronically, again, it's page 17 physically at the bottom of the page, you'll see
Eric.
a potential portfolio. Yes, Mayor.
Eric, before we jump into page 20 and the rebalancing conversation, I think that we should get into more of the allocation question. Can you tell us more? So the 8% that comes from hedge and goes to equities, I know that you've added a number of different asset classes. And can you just articulate to us, what your thinking was with, how much you increased one asset class versus another?
Sure. So with respect to the request to reduce exposure, what's embedded in this is, as you would see in the coming pages, Mayor, is a reduction in half of the exposure to Renaissance, the hedge fund that has been recently underperforming. So cutting that exposure from approximately 9% to 4.5%, and the hedge funds were under their target as well. That added up to a total of 8 points in order to achieve that would go somewhere else in the portfolio. And because the hedge funds are, more, of course, Renaissance is more equity-like, and even some, it's also with Quellos as well. They have a lot of long-short equity exposure in that fund of funds as well. In order to get the best risk-return trade-off or keep the return expectations up in the range that we would want, which would be in the high 6s, close to 7%, that would require sending that allocation to equity. So we wanted to do that. We also wanted to spread it around to the various asset classes. So each was increased, yet we still keep our value bias that has been in the portfolio for many, many years, actually. It's a little less of a value bias, but nonetheless, it is still there by a couple of few points in each category: large cap, mid cap, small cap, and it's also still maintained in the international space as well. Although what you will see is essentially a cutting in half of the exposure to Brandis, which is a deep value manager, and going and sending that money to the passive index fund, which would be more growth and value, both growth and value. So you actually have less value exposure in total because of those types of changes, but you still maintain a moderate overweight to value, which we believe in the very long run, we're talking many years, will tend to outperform growth. And of course, currently, there's a lot of folks who think that maybe now finally value is going to catch up to growth, or at least make up some ground, because it's been trailing by a huge amount in recent years. Actually, since the great financial crisis, it's sort of started, but it became quite extreme last year in the recent few years. So that's the thinking behind those individual percentage weights in the potential recommendation.
Got it. Thank you. Are there any other questions? And I know they go together, but as much as possible, I'd like to keep some clarity and distinction between the asset allocation conversation and the rebalancing conversation. Of course, if folks have a question that touches on both, I mean, we can certainly cover it. But unless there are any other questions purely on the asset allocation, we'll ask you Eric, to go forward on the on page 20 to talk about the rebalancing. Is there anything else purely on asset allocation? Okay, Eric, can you continue on page 20 now?
Yes, Mayor. So if you go to electronic page 20, you will see how we would get there to that newer allocation, less alternatives, more domestic equity, more passive equity versus active equity. And this is how we would do it. Now, there's a lot of moving parts here, so we'll try to walk you through it, and future pages write it down in words as well. But this is on one page what would happen. So we would use $9.5 million of cash. You actually have more cash than that right now, but as you see in the note, there's a $7.5 million benefit payment that's to go out today or tomorrow. So we're accounting for that. So that would leave about $9.5 million available in cash to reallocate. So that's what we're showing in the immediate rebalancing column. Take $9.5 million from cash. Also, you'll see, again, going along the lines of some more passive exposure, continuing the redemption path that we have been on from Columbia Value Path Management. So we would recommend pulling $14.1 million from Columbia, and you'll see right below, pulling $13.2 million from Vanguard Value Index Fund. That is a passive fund. However, this is another thing for the board to consider. That fund, which like the majority of assets that are passively allocated to large value and growth, that fund is the Vanguard Value Index Fund, is benchmarked to the CRSP index. And there have been some questions in the past about, what's the right benchmark for our portfolio benchmark. Mr. Hirsch has asked about this in the past as well. So what we could do, it's not necessary, but what we could do is pull the money from that value index, large cap value index fund, and take those two sources, which would be Columbia and the Vanguard Value Index Fund, and put it into a different Vanguard fund, which is the Vanguard Russell 1000 Value Fund, which is benchmarked to the Russell 1000 Index, which is what we have been using in our benchmark for many, many years. So that is available to the board, and we could kill multiple birds with one stone: increase passive allocation to large cap value equity, and put it into a fund which was going to track the Russell 1000 very much more closely than the original Vanguard fund, which is benchmarked to a different index, the CRSP index. They're both very good indexes. We're fine with either index or either benchmarking. They're different. They have slightly different definitions of large cap value. That's what leads to their differing behavior across the years. But nonetheless, either would be fine. It's really up to the board that says, geez, we'd like to track our benchmark even closer. And sometimes the passive benchmark matters because sometimes CRSP does better than Russell 1000 value, or sometimes Russell 1000 value does better than CRSP. And so that can lead to differences versus the benchmark. So we could make this change, and then you would be fine and you would track the Russell benchmark very, very closely. Or we could stick with what we have and put the money into the same value index fund we have right now and just change the index in our benchmark to the CRSP index. Either is fine with us, but that was also the subject of discussion and questions in recent meetings. So that's where those numbers come from you could consider that, and we could discuss that here in a moment as well. Similarly, as you walk down that column for the immediate rebalancing, you see that we would say we could pull 5.2 million from the current fund that we are in, which is Vanguard Mid-Cap Value, and we could switch that to the Fidelity Mid-Cap Value Index Fund. It's only 5 basis points as a fee. It's actually even cheaper than the Vanguard Fund, but they're both extremely cheap, and we would actually be adding. So you see, we'd be pulling 5.2 million from the Mid-Value Fund and going 7.2 million into the potentially the new Mid-Cap Value Fund. Same story there. Different benchmarks, CRISP versus Russell 1000 value. Similar story for the Mid-Cap Growth. Quite, the funds have been doing what they're supposed to do, benchmarks to CRISP, but those returns, because they are different benchmarks, vary sometimes, and they can affect how you do relative to your benchmark. But you would see we could pull from there and add 18.2 million to that, using that which we raised from the original fund and some cash as well. We also recommend pulling 1 million from Boston Partners Small Value, and we could adjust, as you see under it, go from our current Vanguard Small Cap Value Index funds to a Russell 2000 Value Fund. So we would be, adding 9.3 million to that fund. So on down the line, you see the recommendation to reduce, again, based on last month's suggestion from the board about considering smaller exposures to individual managers. Brandis Investment Partners is our deep value international manager, again, deep value, which has been very strong since inception, but in recent years, because growth has so far outperformed value, the same phenomenon has occurred with respect to Brandis. It does very well against an EFA value index, or against EFA itself, which has a lot of growth in it. It has been trailing in recent times. So we could pull 18 million from Brandis Investment Partners and bring its weight down to about 6.7% from about 11.7%. And we could take that money and put it into our index fund that we're already using, which is the Fidelity Global ex-US Index Fund. Slightly different index than EFA, of course. It's the All Country World Index, has a little more emerging market exposure than the Brandis benchmark, but nonetheless, we could go in that direction. You see how we would get there. And so in total, you would be using 9.5 million in cash, a lot of movements inside, and that would get you in an intermediate stage well along towards the new benchmark, the new asset allocation, if you decide to keep it. We have another column to the right called additional rebalancing. So as part of this, again, based on the board's asking us to consider smaller allocations to individual managers, this allocation recommendation, as you can see in the additional rebalancing column, recommends pulling 16 million from Renaissance, effectively cutting that exposure in half from about a 9% position to a 4.5% position. However, while that's monthly liquidity at Renaissance, if the board were to accept the recommendation, for example, and voted on that today, then the money would be out at the end of April. So you have to get it in basically a month before the month you want to get out. So you would be able to get out at the end of April, 2 months from now. You would have your money to reallocate. And that's what that additional rebalancing with Renaissance proceeds columns show. using that money, that 16 million, when you get it, which would be at the end of April, you could take that money and allocate it to the other line items that you see there, and that is designed to bring those line items, those individual rows, essentially to the new target weight. You can see we add a little to Russell 1000 growth. We add some to Loomis sales, 7 million. We routinely do that, and that gets everybody basically back to what would be the new target if you decide to go in that direction. So it's a sort of a two-part process, as the mayor was saying. You have your new potential asset allocation with smaller exposures to individual managers, and therefore a new target. And this is how we could get there if you so choose. I know there's a lot to unpack there, but that's what this page is showing.
All right.
I'll take
Well, thank you.
questions, Mayor, if you like.
Thank you, Eric. I'll go with Commissioner Lombardi, and then Commissioner Costello has a question as well.
Thank you, Mayor. I'm just, so if we come out of Renaissance with $16 million, is there any potential loss by doing that? So is there, because there's a run on, I mean, if there is a run on it, or whatever reason?
No, our 16 million would have no impact. It's currently a $22 billion fund. So it's an enormous fund. So the act of taking 16 million out would have no impact.
Okay, and you think that it would be, I mean, we wouldn't lose value by moving now?
Oh, okay, that's a different question. That's a timing question.
Right.
They're up this month. They said they didn't give us a number, but they said they had a strong week this week with the volatility in the markets. But again, in order to have a smaller allocation to individual managers, you have to remove the money at some point, and so that's more of a timing play. I will tell you, other of our clients will be adding money, new money to the fund. So we're still confident in the long-term returns for the fund, but and they're sometimes contrarian. They like to add to managers who are down recently. But in this case, in order to get it down to below a 5% allocation, this is where the $16 million pull comes from. You don't have to do it now. Could do it in the future if you like, but we perceive that the board was interested in considering smaller allocations to individual managers, so that's why we have it. We've done it right away at the next meeting for the consideration.
Thank you.
Commissioner Costello?
So a couple of questions and maybe a clarification. So Eric, you speak a lot about the CRISPR index and the various sub-indices of each one of these funds. And I not to put words into Mr. Hirsch's mouth, who's not here to comment, but having spoken with him, I think the issue is, if we had a basic 60-40 index with 60% S&P 500 and 40%, some kind of intermediate bond index, then what happens is the evaluation comes on really the benefit and wisdom of the allocation that is recommended by Wainwright. And it's not so much can we beat the CRISPR index by getting into the Vanguard funds and all that. I think it's looking at what a ultimate passive index would do, and are we adding value with all of these various allocations and style tilts and et cetera, et cetera. So that's my kind of comment clarification on that. And then to follow up on Mr. Lombardi, Treasurer Lombardi's comments, while I like much of what you're talking about, I am a bit concerned about the vast dollar amount you're talking about moving around, and the timing at which we do it. We don't want to get in a situation where we're out of markets for weeks at a time, or there's, as you know, you miss a week, you could miss the whole year. That may work out great for us, it may not. And so I'm a little concerned about the sheer magnitude of it, and wondering if consideration of a pacing model might be a little better off. And then finally, I noticed that Robeco is the one fund that you really didn't change anything on, and that's going to be, from an equity perspective or from a fund perspective, I think it's like 15-16% of the overall. I understand it's in two different funds, but now it kind of really stands out as a very significant investment in one firm, which is not index based. So I'm curious about your comments about that.
Okay, well, that was sort of, going forward, that may be the next area that could be reduced, but getting to the point you made, we were just trying to pick it and pace it. So if we'd have tried to change that, it would have been even larger amounts of funds that we're moving. However, in this immediate rebalancing, most of it, Commissioner, is from one index fund to another, which would happen in a day when you go from one index fund to the other. So you wouldn't be out of the markets. With respect to pulling from active managers, historically, it has taken them, 3 to 5 business days to generate the funds, and then they would be reinvested. So it would probably be some amount in that range, say the money that was coming out of Brandis or the money that was coming out of Boston Partners, Robeco. That's $1 million this time. But the other moves are index fund to index fund, except for Columbia, of course, same story. But yes, pacing is something to consider. With respect to Chris and Russell, again, we're not saying that Russell is a better index than Crisp or vice versa. We're just saying if you want to have the returns of your indexes and therefore your portfolio to track the benchmark, then you should consider
but
having.
You're missing the point, Eric. You're missing the point. That's not. We don't care whether we track the CRISPR or the Russell or what have you. What we care about is that we get the best rate of return with an appropriate level of risk for this fund. And one generic way to determine whether that's working out and whether our decisions and our allocations and everything are benefiting the plan is to look at just a basic 60-40 autopilot index that we could almost do on our own, and see where that would have us. And so that's why you have the static index, and that's why we've asked for it. And I don't think anybody's focused on the CRISPR versus the Russell versus the S&P.
Yeah, I think I understand what you're saying. What I'm trying to say is you could just, in your benchmark, you could just use the CRISP index, and then you wouldn't have to change these index funds, or there would be no need to consider changing the index funds, and just use that in your benchmark calculation. In fact, more money is passively indexed to CRISP than is to Russell 1000. So there's that. It's just an attempt to reduce the tracking error to the portfolio benchmark. Both are fine with us. We are okay using either CRISP or Russell. It doesn't matter. The simplest thing would be to pull money from Columbia, let's say, and just put it into the Vanguard fund that you're in now, which is large, it's $66 billion, and just adjust your index and track CRISP. That's what a lot of people do. So yeah, a lot of institutions do. They track CRISP instead of Russell, for example. So that's the index question. The value versus growth question, which was the other part of your question, is the academic research for the last 35 years or so, 35 years, has shown, and we are adherents to it, that in the long run, value outperforms growth. So that's why we have a recommendation for a slight value tilt over growth. The S&P 500, for example, oscillates across time, but that's often 60-40 growth versus value, especially when growth does so well. So if you think about the S&P 500, you're really thinking about a growth bias if you were to just put it in an S&P 500 index fund. Our philosophy for our clients for 20 years or more has been to have a value bias, which is why you see still a value bias with the passive this move to potentially different passive indices as well. So that's where that comes from. Still, it's a great deal of passive exposure, continuously, again, pacing, to use your term, increasing passive exposure across time.
Are there any other questions or comments? Right. So there is a lot to unpack. There's a lot to unpack and a lot to decide on. But let me see if I can make it as simple and tee it up for us. What it is that we're considering, and I hope this doesn't come off like unnecessarily harsh, but Eric, we're tasked with two things. We set a strategic direction for the fund, which is essentially the asset allocation question that takes into account how much risk we're willing to tolerate, and how we allocate among the different asset classes. So we're tasked with making that strategic decision. Beyond that, the second thing that we're tasked with evaluating as a commission is how well you, our investment advisor, articulate and explain the investments that you're recommending, so that at the end of this process, or as we go through this process, we either feel comfortable or not accepting your recommendations. And if we accept your recommendations, it's with the purpose of holding you accountable at the end of the day on what the returns are. And that's important for us, because as we're evaluating any investment advisor, we want to make sure that we're evaluating the performance of that investment advisor, and not the performance of us as commission members investing here or investing there as part of the balancing conversation. So there is a lot of information and material there, but at the end of the day, what we're evaluating is, what is your recommendation? What are your justifications for the recommendation? And is it something that we accept and will give the go ahead to make happen? So my question to you, Eric, is, over the course of the last several meetings that we've had, there have been recommendations from various commission members, and I appreciate how you've taken those recommendations and you have presented options to us going forward. But my question to you is, with the understanding that you will be held accountable for the results in this, for the results that we get. What are your recommendations? And the recommendations that you've laid out on these sheets on page 17 and page 20 that we just went over, are they your recommendations, or are they or are they recommendations that reflect? Well, let me just leave it at that. Are these your recommendations?
Well, the answer is yes. They are our recommendations, but remember, we are giving recommendations to try to best match the risk return profile of the client. So they are our recommendations, yes, but we're giving those recommendations contingent on trying to respond to the feedback and build the risk return profile, and the way that you get there, for example, passive versus active, etc., that most closely matches the client's risk return profile. So they are our recommendations, which are designed to meet what we believe is the risk return profile of the client.
Yeah. Okay. And by and large, that that decision is made by the commission in the reallocation conversation. So one other question. So Mike, in your question to Eric about phasing this in, after hearing Eric's comment about being in the market and not being out of the market for a significant period of time, were you satisfied that that if we move this level of dollars around, that that it's fine, or is the phased in approach still something that you are recommending?
So two things there. One, I would not necessarily move money out of a Vanguard fund because of the index it monitors. That over a period of time, it gets pretty close, and to move money just for the sake of attaching it to a different index doesn't make sense to me. In terms of the timing, I think we have to defer to Wainwright, and I would be comfortable giving them a level of discretion with the overlay that we want a tremendous amount of care and diligence to be placed in the timing so that we're not left out of the market by any significant event. And if that means doing it over a 2-week period, so be it. If Renaissance appears to be, starting to make a recovery, having a little bit of discretion there, I think makes some sense. I mean, Renaissance is off almost 50% from its high. I don't know about the inner workings, but clearly they've been on the wrong side of things for a reasonable amount of time for the last 18 months. And they may be subject to some level of recovery. I just don't know it well enough. So my recommendation would be to give Wainwright the guidance to be very, very thoughtful about the timing, to be given a bit of discretion in terms of when these transactions would be completed. I would not necessarily be in favor of moving money from one fund which has a CRISPR index versus the Russell index.
Okay. Thank you, Mike. And let me go back to Eric and make sure I get this. So I think that makes a lot of sense in deferring to our investment advisor on the timing of this. And on the last point, so Eric, if I understood you correctly when you were explaining the move from of money in these funds to track a Russell as opposed to a CRISPR, if I understood you correctly, you were saying that there really isn't much of a difference either way. Is that accurate, or is this a really important decision and question for us to weigh?
No, there isn't much of a difference over the long run. from one year to another, there can be a difference, but over the long run, there isn't. And so therefore, we're fine with that. And we would be therefore fine, based on Commissioner Costello's points, of leaving it in the index that we are in already, the Vanguard Value Index, and we'll just be judging it against the its CRISP index. So that would be perfectly fine with us as well. We agree that that is okay, and we would recommend to do that based on that discussion.
Okay, great. I'd like to hear from any of the other commissioners. Does that all sound good to you? Commissioner Lombardi?
Mayor, I'm trying, I'm trying to figure out exactly what authority we are giving them. Maybe we're not there yet. We have a schedule in front of us, and I'm wondering what part of that schedule is he going to exercise?
Well, we could say it verbally now, or we could just return next month with that if you'd like, commissioners. That's up to you. But to answer your question, in this case, if you look at it, do not subtract 13.2 million from Vanguard Value Index, and in fact, just add the 14.1 from Columbia to it, and therefore do not add Vanguard Russell 1000 Value Fund, and so on down the line. Do not subtract 5.2 million from Vanguard Mid Value, just add the 7.2 million to it. Do not subtract the 8.3 million from Vanguard Small Value Index, and just add the 9.3 million to it, for example. So that's how this sheet would change.
And Mayor?
Of course.
And so I'm moving on to Renaissance. Would you be moving all $16 million in one shot from Renaissance? And is that what is that what we're asking you to do?
Well, I think that was what Mike was specifically referring to, moving the dollars out of Renaissance. Correct me if I'm wrong, Mike, but that was the
that was one of them. Yeah.
Okay.
So I'm just wondering what the direction is that we're asking him to go on Renaissance.
So the recommendation
I'd be
would
personally, I'd be looking for input from Eric.
Right.
Yeah.
Okay, well, if the board is tolerable, it can tolerate and finds acceptable going slower to get to that new target, then we could reduce the recommended redemption size and do it in stages across time for further consideration of the board in future months. So feedback would be you could pull half that amount, pull 8 million from Renaissance, and then use it to reallocate when, of course, we have to wait to get the money, which wouldn't be until after April. And then we could provide you with a new rebalancing recommendation at that time. But we could pace, to use the term, pace the reduction by shrinking it to 8 million, for example, at this time, which the board could vote on.
Sorry, Eric, I'll ask you the same question. I mean, that is one way to do it. Is that your recommendation on how to do it?
I'm okay with that. That would be my recommendation. Again, conditional on the feedback that I'm getting from the board. So in an attempt to match the process to the board's risk return tolerance, that would be my recommendation.
Hey, Eric, that Renaissance, when you pull money out, you have to give advance notice. When is the money when do we get out of the fund, and when do we get the money from the fund?
If you were to vote today to make a redemption, the money would come out at the end. That money would be out of the fund at the end of April. So it would still be in there for March and April, and then you would get it in the beginning of May.
Okay. So you're in the market and then you're out of the market for a couple weeks.
You're out of, yeah, that money, yes, that you're waiting on would probably be that amount of time, yes. In this case, that $8 million would be a week or two, yes.
Okay,
While you're waiting for it to come back from the fund.
okay.
So,
Commissioner Lombardi?
so Mayor, just an idea. I mean, do we want to, whether it be 8 million or 4 million over the next 4 months, just give them an automatic unless we say no. So it's 4 million this month, 4 million, or 8 million, 4 million, 4 million, or I mean, whatever the board wants to do. Rather than him coming back, should we just give him a directive? And then we can always say no at some point. But just
Yeah.
to put out a plan.
Yeah, let me make sure I understand you, Commissioner. So, I think that, the plan that's presented to us is for a decision to be made today, and then Eric sets it in motion immediately. What I'm hearing, however, is that we can set a target allocation and agree to the bottom line rebalancing numbers today, but defer to him and give him leeway in terms of time as to when to reach that target allocation and the target balancing. Is that what you're recommending as well, Commissioner?
Yes.
Yeah. And Commissioner Costello and Winkleman, so, it still leaves the question of moving money and funds to change indexes, but setting that aside for a moment, does that sound good to you as well? That we make the decision today, but give him additional time and defer to him on timing of it?
Yes.
Yeah. Yes.
Okay.
Recognizing that the 16 million that we're pulling out may mean nothing to them, but it's a significant dollar amount to us.
Right.
So the timing and execution is important.
That's right. Okay, so we have this. So we have this done, and I think we're in a good place. The only challenge that we have right now is that we don't have it spelled out in front of us on this page 20/page 17, the rebalancing page.
Mhm.
Now, we've done it in the past where we've made changes, verbal changes to this. We approved it as in the document subject to other changes, but I'm afraid that there are a number of numbers that we would be moving around. And so I'm just concerned about this motion being overly confusing unless we have it spelled out. So let me ask this. Eric, can you take our feedback and put it into a document just as you have here, revise it, and perhaps we can meet next week, or as soon as we could call another meeting together to set this in motion?
Yeah.
Yes, easily, Mayor.
Okay. How much time would you need to do this? I mean, I think you could turn this around in a matter of days, right? Matter of hours.
Yes, yes.
Okay. Okay, so let's do that. And commissioners, as long as you all are willing and make yourself available for a meeting next week, does that sound good?
Like at 12 o'clock?
We'll find the time. We'll make it work.
Yeah. Yeah.
All right, great. Are there any other questions on this before we move on?
Before you move on, Mayor, may I have a motion to continue that matter to the next meeting?
Okay.
Motion.
I'll entertain a motion to continue matter number 2 till our next meeting. So moved by Commissioner Costello. Is there a second?
Second.
Seconded by Commissioner Winkleman. Any discussion on the motion? All those in favor, please say aye.
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 Any opposed? Okay, great. Thank you, everyone. All right, matter number 3, update on Spotlight Ticket Management, AKA Invite Manager. Eric.
Thanks, Mayor. Very quick. The board has done everything that is necessary. The documentation was signed. It was sent to Blackstone, the buyer. They called us a couple of weeks ago and said that they recommended holding off on processing the finalization of the sale because they were told that there was a potential buyer of the company that had approached the company away from Blackstone, and that since that may occur, we should just hold off for a matter of days until they knew it was possible you could get it an even higher price than what you signed. Subsequent to that, they called us back and said the board of the company decided not to pursue that offer. There are no other offers on the table, and that all other sellers have consummated the deal, and that they just wanted to let us know that so they can finish processing the sale, and according to them, wire the money to the fund, to the city, by Friday or early next week. So that was just the update we wanted to give you with respect to, that's why the money hadn't arrived yet. They were trying to see if there would be a chance to get a higher price in the interim. It doesn't look like that's going to happen. So nothing else for the board to do, just updating on the process, and the money can be, will be being wired in a matter of days.
Okay, wonderful. Any questions on that for Eric? All right. Well, thank you, Eric. And we don't need a vote on this, do we? Oh, hold on. There's a Mike. You have a question?
Well, my question is, I can't speak to this, so I didn't know whether I need to recuse myself, but if there's no vote, maybe I don't need to.
Do not, because we're not voting on it, so it's just a discussion item. So you're all set.
Okay. So, all right, so we'll just move on. Thank you, Mike. We'll move on to matter number 4 now. Discussion relative to Dexter Donation Fund. What I recommend is, I really want to cover the next one. What I recommend is that we continue the matter number 4 until our next meeting. And is there a motion on the table to continue matter number 4 for our next meeting? Okay. Motion made by Commissioner Winkleman, seconded by Costello. Any discussion on the motion? All those in favor, please say aye.
Aye.
Any opposed? Okay. Matter number 4 is continued to our next meeting. Let's go to matter number 5, request to transfer $35,000 from the Charles Smith Trust, currently available to expendable account 819. I'll pass it to you, Karen.
Good afternoon. We're looking to transfer $35,000 from the Charles Smith account to the Botanical Center revolving fund. And this is just to cover the cost of VESDA boxes, which are required by the fire marshal in that area. I wasn't sure what VESDA boxes were, but I guess they detect smoke and fire, and they're tied to the sprinkler system. And this is the only way that we'll be able to afford it for the Botanical Center this year.
Okay, just 2 questions. Is this consistent with the purposes of the trust? And roughly what percentage of the account would this entail?
I left that paperwork at my desk, but it is consistent with, and I believe it was less than 1% at the last Board of Park Commissioners meeting. It was in that paperwork, and I did send a copy of the approval from the Board of Park Commissioners to the city clerk and also to the treasurer.
We did distribute it to all the members, Mayor.
That's great.
I believe it was less than 1%.
That's wonderful. And Ken, can you attest that this is consistent with the purposes of the trust?
Yes, I can, Your Honor.
All right, that's great. Any other questions?
No.
Okay, I'll entertain a motion to approve the request to transfer $35,000 from the Charles H. Smith Trust Fund to the expendable account 819. Is there a motion?
So move.
So moved by Commissioner Winkleman, seconded by Commissioner Costello. All those in favor?
On a roll call vote, please.
Okay, we'll do a roll call.
Mayor Alorza,
Aye.
Vice Chairman Lombardi,
Aye.
Councilman Igliozzi is absent. Ms. Silveria,
Aye.
Mr. Costello,
Aye.
Mr. Hirsch is absent, and Mr. Winkleman.
Here, aye.
We have 5 ayes, 2 absent. The motion carries.
Great, thank you, everyone.
Thank you.
And Ken, I believe there are no issues relative to litigation to discuss today?
You are correct, Mayor.
All right, I'll entertain a motion to continue matter number 6 till our next meeting. Is there a motion?
So move.
So moved by Commissioner Winkleman. Is there a second?
Second.
Seconded by Commissioner Lombardi. Any discussion? All those in favor, please say aye.
Aye.
Are there any opposed? Okay, matter number 6 is continued. I'll entertain a motion to adjourn.
So move.
So moved by Commissioner Winkleman, seconded by Commissioner Costello. All those in favor, please say aye.
Aye.
Any opposed? All right, thank you so much, everybody. This meeting is adjourned. Appreciate everyone's time.
Okay.
Thank you.